What is an asset, and how would you describe the ideal asset? Hello and welcome to the Durham Talents channel. My name is Jesse Durham. Today we're going to begin by discussing assets. What are assets? When should we get them? How should we get them? Why should we get them? Now, if we begin describing an asset, I know that there are folks out there like Robert Kiyosaki, the author of Rich Dad, Poor Dad, who describes an asset as something that would put money into our pockets. So something that inherently cash flows. Also, I would say that net worth can easily come into the conversation when discussing assets, because a net worth is one particular metric to show what we own versus what we owe. So if we were to take everything that we own and liquidate it, sell it, take that number and then minus from it what we may owe, what outstanding loans or lines of credit, etc., that we may have, and that will help us to arrive at a technical net worth. And of course, the more assets that we have, the greater that net worth is. So I like this question when discussing anything personal finance with folks, and that's just asking what is their definition of an asset. And if they arrive at something close to, well, something that does increase my net worth or something that does provide me with a cash flow, beautiful. What other descriptors would you use to describe the ideal asset? Now, I know that I've arrived at several from reading R. Nelson Nash's book, Becoming Your Own Banker, and from practicing the infinite banking concept in my own life for the past several years. My wife and I, and now our family and our business, as we've used this concept originating from Nash's book to become our own banker, to implement a privatized banking system and strategy in our own lives and in our business. And the descriptors are several descriptors. But again, I would like to ask you, what is your definition of an asset? When should you get assets? Are you doing something systematized where once a week, once a month, once a year, or multiple times in whatever time frame you're systematically going about procuring assets for yourself? Or is it something randomized that you just look for a deal in whatever industry or investment or process that you're plugged into? How are you going about doing that, and when? I believe it's Simon Sinek who has this idea of start with why. And I believe that when we arrive at deciding to increase our net worth or to provide for a cash flow or both or more, then naturally the more assets that we have, the greater that cash flow or the greater that net worth or whatever gauge or metric we're using, the greater it will be, of course. Now, Nash in his book, Becoming Your Own Banker, points out the two ways to earn. So the first way to earn income would be with your hands, with your time, with your experience, with your knowledge. So in whatever profession or whatever business that whatever employment, whatever it is that you're doing traditionally for yourself, your time, experience, your two literal hands or your team or your business, your group, that is one way to produce income for yourself, is people at work. The second way is for money to be at work. And I think that's where more relevantly we will move into discussing assets and moreover the ideal asset further by beginning to evaluate how our money can be at work for us. So if we would begin to view our dollars as little employees, and the more employees' dollars that we have at work, that may alleviate time that we have to actively spend working by creating passive income or residual income. So money being at work. So when looking at assets, I believe it's a very valid concern to consider the pros and the cons of any given item. Now, I'm not going to say, well, do cryptocurrency but not precious metals, or do precious metals and not cryptocurrencies, or well, do real estate and not stocks and bonds, mutual funds, or well, do stocks, bonds, mutual funds but not real estate, or anything else. I'm not going to be making any suggestions. I think, and I'm certain actually, that I'm going to promote the idea that you can become your own banker. So this whole idea of finding the ideal asset is going to be through an infinite banking lens, because the banking process is taking place on precious metals, real estate, paper assets, etc. Fill in the blank, cryptocurrencies, anything. The banking process, and that's going to be the key word there. Nash points that out very clearly in his book. He doesn't talk, self-admittedly, about assets of any kind in his book. What he's talking about is the process of banking that takes place. So I'm not making any suggestions on investments. So let's just make a clear distinction between investments and assets. Assets don't necessarily have to be investments, nor do investments inherently mean that they are assets. Again, depending on our definitions, but you could have an investment. You could have money invested in something. And if it is not providing a cash flow for you, it's not really being an asset to you. So it may be an investment, but not an asset. Likewise, there are plenty of folks out there in the financial and entertainment world who would promote the idea that you lock your money up somewhere and not touch it for 10, 20, 30 or more years for an eventual passive income. Hopefully. Again, there's so much there. The future is so very unknown as far as taxes are concerned, and is that number going to go up or go down? I mean, what are your guarantees on lots of places where we're promoted to put our money? We don't know. I don't know, and you don't know. We don't know. So assets and investments very well may be different things. So in us focusing firstly on assets. So let's begin by describing the ideal asset. Let's consider a high rate of return, an asset that is private, an asset that is consistent, an asset that is conservative or safe, an asset that has liquid access to capital, an asset that's guaranteed, an asset that has tax deferred or even tax-free benefits, an asset that is not exposed to market volatility, an asset that protects us against inflation, an asset that gives us control, that is transferable, that is easy to manage, an asset with no hidden fees, no penalties, and an asset that is reputable. Now, in considering all of these different characteristics, and these are decidedly describing a properly structured whole life policy with a mutual company. So when I say properly structured, I'm talking about a policy that has been properly structured for an individual according to their need of finance. And it will be done with a mutual company, making that policy owner a part owner of the company as well, and a company that has consistently paid dividends for well over 100 years consecutively. Now, when I'm discussing assets with a prospective client, more often than not, and sometimes still with clients that are early on in their process, their mind will normally go towards investments themselves. And that's where, again, we're going to make this distinction between investments and assets. An asset is going to be something that will increase your net worth. An asset, very well, at least according to many, will also produce a cash flow. Now, an investment, and let's just we can take several examples here because I'm not making any suggestions, but let's say you invest in precious metals and you buy physical precious metals. Now, those precious metals, they're going to be stored somewhere, and the value of those precious metals are put away with the metals themselves, meaning you cannot realize a monetary gain until you liquidate those metals. So there will not be a medium of exchange, okay, money changing hands, until you liquidate those precious metals. So perhaps you buy low, sell high, and you realize a gain. Sure, fantastic. And there are other things to consider when going into investing. And I'm not saying don't invest, but I am saying taxes are going to come into play in a big way, just to name one of the obvious considerations. But there are others: theft, market volatility, a lot of these other characteristics that we were talking about when considering assets. Now, again, I know that I'm talking about investing now in particular, but precious metals. How about real estate? And again, I'm not trying to disparage anyone from doing real estate investing, but we must realize that there are lots of ways to do real estate investing, and that can look very different. You may procure a residence or a parcel and have that simply add to your net worth just by owning it, whether it's mortgaged or leveraged or not. That will add a certain amount to your net worth. Now, if you're acquiring a property for it to cash flow for you, well then fantastic. Of course, you're expecting the renter to be covering the taxes and the insurance and the maintenance, etc., and you to earn a profit above and beyond that. And again, taxes come into play. Again, losses or market volatility come into play. Let's say it's a fix and flip. Let's say you're buying a place, you're putting something into it to be able to turn around and hopefully sell it for more. Again, there's no promise that the markets always go up, because they don't. And I know that real estate professionals will say very quickly, and truthfully so, location, location, location. You've probably heard that. Well, if there's one factor that's more important than location, it would be timing. Because certainly in history there have been times, and Nash writes about one personal experience in his life, in his book Becoming Your Own Banker, where he was stuck with $500,000 of outstanding debt with a commercial, conventional bank at 23% interest, I believe it was. It was and that was just timing. It wasn't that he had a poor location. It wasn't that he'd made a poor decision on a particular property, but rather the timing of the market. And I can't know that. You can't know that. Nobody can know that. So if there is something more important than location, it will be timing. And we don't know. But again, if you're doing a fix and flip, you're having money that's tied up in that. Of course, we could look at some of these characteristics again right there. Well, are there any guarantees with that? No, there aren't any guarantees. And I know that there are plenty of folks with a high tolerance or a low tolerance on risk. And you can make your choice there, but I'm just saying these are things to consider. What about taxes? Well, when you earn income, is that not going to be capital gains? And again, that's a discussion between you and your accountant and the other appropriate professionals. But I'm just asking us to consider the differences between types of investments, just for conversation's sake. Again, I'm not making any suggestions, but also pointing out some differences between assets and investments. Sometimes they are one and the same. Sometimes they are not. And we'll get to another example here in a second, but let's see. We've talked about precious metals. We've talked about real estate, and there's lots of different, there's a lot more we could talk about real estate. There's a lot more we could talk about precious metals even. There are folks who promote the idea that you could own shares of ownership of precious metals without actually procuring and buying and having the physical metals themselves, EFTs. So that's all very interesting as well, of course. How about the more obvious stocks, bonds, mutual funds, 401ks, IRAs, etc.? Again, that's one of those categories where we are encouraged to put our money locked up, don't touch it, set it and forget it, 10 years, 20 years, 30 years plus. And again, we got to ask ourselves, well, what are the guarantees? Is there any guarantee with a 401k? Probably at least one, that it won't go below zero, but that's not very encouraging. Again, the timing of the market, how do you know? And I know there's a lot of information, maybe propaganda out there about 12% this, 8%, 10% in the market over the years. But again, we must consider, just like with real estate, timing. How do we know that when we reach passive income years and it's time for us to be able to access some income from that nest egg that we've been encouraged to put away? How do we know that the market's going to be up at that time? How do we know that it's not going to be tanking? We don't. I don't. You don't. Nobody does. What about inflation? What about the fees and penalties? That's going to be a big one on the qualified plans, the IRAs and the 401ks, the fees. Just like it's endorsed that a 401k is a great place to earn compounding interest because you just keep putting money in there and you don't touch it and it builds on itself. Well, what does that mean for the fees and the penalties over 10 years, 20 years, 30 years? Doesn't that mean that they compound as well? Yes, it does. Things that you don't hear about. And again, I had a 401k. I had a state retirement plan as well from being a law enforcement officer and a teacher in the state of North Carolina, both. So I've had those before, and I know that I was someone who was just paying monthly into that program and probably barely knew two things. Probably barely knew whether I'd put a low, a medium, or a high risk setting on my approach and whether my overall number went up or down based off of my quarterly statement. And other than that, I didn't know anything about those 401ks and those state retirements and whatnot. So those are just several examples of a lot of the most highly talked about investments that are out there. The cryptocurrencies, the precious metals, real estate, paper assets, stock bonds, mutual funds. Now let's begin talking about specifically again, whole life policies with a mutual company that's been properly structured for the banking purpose and that pays a dividend. This is an asset. Policies described the way that I've just said are an asset and not an investment. When you buy a whole life policy, you are mitigating risk. You're offsetting risk of your mortality to the company. You agree to pay a certain amount of premiums, and the company agrees to pay you a certain amount of death benefit. And this policy, it's permanent and it's got all these other characteristics that I said. And it would be great to talk about each one of these aspects. And we could talk, individually about each one of these subjects, I think, for an entire podcast in and of themselves. The control, the transferability, being easy to manage, no hidden fees or penalties, reputable, all these different characteristics. But a policy that offsets risk in this way is not an investment. In fact, even the IRS says that, for example, the dividends that you receive by owning, part of the company, being a part owner of the company, by being a policy holder, that is simply a return of premium. Now, that's an IRS definition. That's a return of premium. So that dividend that we receive is a return of premium, because you need to recognize how the insurance industry predates the IRS tax code that began in 1913. Life insurance has been around for hundreds of years. I own policies with companies that have consistently paid and consecutively paid dividend every year for the past 145 years. So it predates the IRS, and buying a policy is you offsetting the risk that your loved ones or the entities that you care about, that you make beneficiaries of your policy, for example, the financial loss that they would experience upon your graduation, upon you passing away. So you're simply trying to mitigate risk and offset risk to the company by paying premiums. And they, in turn, of course, promise to pay a particular death benefit as described in the contract and everything else that is in that contract. So yes, that's why it matters which company you're getting policies from. And I'm not married to any one company. My wife and I own multiple policies with multiple companies, and we've systematically been adding to our system of policies that we privately own over the past several years. So I'm not married to any particular company, but that does matter. And it does matter what source you're going to for your information on how to practice infinite banking. And getting appropriate definitions for these appropriate categories of, well, what is whole life insurance? Because, like Nash said, most people's understanding of life insurance is based off of someone else's misunderstanding. And then we, categorize investments, and then we got to give that an appropriate definition, and then assets. So again, for assets, a properly structured whole life policy with a mutual company that pays a dividend meets, in my mind, and I hope that this will be a good study for you, all of these criteria of being the ideal asset. Lots of folks in the space call it the and asset, because regardless of whether you're interested in investing in real estate or in paper assets or in cryptocurrencies or in precious metals or in anything else that you want to invest in, the banking process, the banking function still takes place. And I'm here to promote the idea that you can become your own banker. So you can procure these appreciating assets called whole life policies and add that to a private system that you own and control that satisfies your need of finance for the investments that you may or may not want to make. So you can procure whole life policies that have been properly structured for your banking purposes, and then you can turn around and access a capital in those policies that you own and control to finance the precious metals, the real estate, the cryptocurrencies, etc. Whereas if we're only taking a percentage, let's say, of our income to buy precious metals or real estate or cryptocurrency or anything else, then we're completely overlooking the banking process that is taking place either way. Because again, remember, either we're paying interest to use someone else's money on their terms and conditions, and that's interest dollars that forever leave our hands, or we accumulate our capital somewhere. Again, my question right there is where? Because money does have to have a home. It does have to have residence. The title of Nash's second book is Building Your Warehouse of Wealth. But that second process looks like us accumulating money somewhere, and then we liquidate that to go out and buy the precious metals or the real estate or the cryptocurrency or the paper assets, completely overlooking that banking function. Whereas if we're practicing infinite banking for ourselves, we systematically build a system of policies to account for our entire financial footprint over the course of our lifetime, and we can leverage the capital in those assets to procure our investments. And again, if we're doing investing, you could do this for a small business that you run, a big business that you could run. You could do this for running your household. I mean, all the way down to the groceries that you buy, the gas that you put in your car, the vacations that you take, the medications that you take, the educations that you finance, the vehicles, what have you. Whatever your financial footprint looks like, who controls the banking function in your life? So I'm here to promote the idea that the ideal asset is properly structured whole life policies with a mutual company that pay a dividend, because again, they yield a high rate of return. They are private assets. They are consistent in their rate of return. They're conservative and safe. They are liquid. There are guarantees. They have tax benefits that are both tax deferments and tax-free benefits as well. There's no market volatility. You're not tied to the market. You get income other than capital gains. It is creditor protected. It is inflation protected. You maintain control. It's a transferable asset. It's easy to manage. There are no hidden fees or penalties. and it is reputable. Again, going back to life insurance being hundreds of years old, it predates the IRS itself and the tax law that began in 1913. So when I'm told by anyone that I'm having a conversation with, or a prospective client, or even clients that are early on in their process, well, Jesse, I want to do this, or I want to do that. And we have clients that tell us that they're wanting to cash flow properties. And we have clients that are telling us about the cryptocurrencies that they're buying. And we have clients that are telling us about the stocks that they're buying. And great. I'm not making any suggestions. I think that you should be making educated decisions about the things that you're passionate about, that you're knowledgeable about. Whatever floats your boat, that's fantastic. But remember that the banking process takes place regardless. I would also like to make the suggestion that we are our greatest asset, that you are your greatest asset. And that's how we can arrive at permanent whole life insurance, again, in my opinion, because I am the greatest financial asset to my family. And it is worthwhile for me to protect them against a financial loss from an early graduation on my part. They would experience a great financial loss of what I am capable of doing over the course of my lifetime. So it does behoove me, and I can't get enough, to insure myself as much as possible. And that will change over the course of my lifetime as well, as our value and our productivity increase. And the same would be said for you. And it behooves me, again, I say, to permanently protect my family from an early loss. So that's why I promote the idea of whole life insurance properly structured with a mutual company that pays a dividend as the ideal asset, because it protects me, because it protects you, which is our greatest asset. I mean, think, why would we insure a phone, or insure a car in the driveway, or insure a home or structure? Why would we go about insuring those things without considering insuring our own very selves? So I would make the suggestion that you are your greatest asset, and that I am my greatest asset, both for ourselves and for those that we love and that we care about, whether that's your heirs, whether that's your beneficiaries, entities that you care about and would like to see perpetuated by your financial experience. Because no one is ultimately getting out of this alive. We have to be thinking long range, like Nash encouraged us. I mean, what if we could think even beyond our need for finance now and how we're going about procuring assets or possibly investments, and begin to think, well, what about our children? What about our grandchildren? What about our great-great-great-great-grandchildren? And on down the line. And then another valid question that I have with prospective clients, and clients, of course, is how do you want a transfer of wealth to look like in your life? I mean, I talk with folks, and of course, folks that come on to be clients with us are concerned with and preparing for future generations. They're thinking long range. They're implementing a process that they can use today, right now, themselves for their lifetime, but that also positions future generations to be able to receive a tax-free transfer of wealth. And it's an important discussion to have. What would you like that to look like? Because again, and I'm not making an argument for any particular investments, but if you have cryptocurrencies, or if you have precious metals, if you have real estate, if you have businesses, if you have paper assets, whatever it is that you want to see pass on to children or entities that you care about, I would like to point out that, again, those investments are not realized until they are liquidated. So it's upon liquidating, it's upon selling that cryptocurrency, or selling that precious metal, or selling, because it's a whole lot easier to receive a tax-free death benefit. And I'm talking about practically being able to split that between different persons or different entities according to your wishes, according to my wishes, for me and you for yourself, than it is for us to cut a house in half, or a bar of gold, or what have you. Having a honking big death benefit certainly provides a very easy and liquid sum that can facilitate a smoother transition of partitioning your other assets or your other investments out according to how you wish as well. So there's a little thought right there about legacy planning. So I hope that this conversation has been interesting for you. I know that I've enjoyed talking about assets and the ideal asset. If you'd like to carry this conversation on, you can reach me directly at 828-817-4223, or you can email durhamtalents@gmail.com. It's been a great pleasure for me. I look forward to our next conversation. Have a great day. Take care.
The ideal asset will have a high rate of return. It will be private, consistent. It will be conservative and safe, liquid, guaranteed, tax benefits, no market volatility, income other than capital gains. It will be creditor protected, inflation protected. You will maintain control. It will be transferable, easy to manage, no hidden fees or penalties, and it will be reputable.